welcome everyone to our final webinar of the summer webinar series. Today, our topic is living well and giving well, and our focus will be on charitable gifting strategies. Just to give you a brief overview of Tortuga Wealth Management, as many of you know, we're a boutique wealth management firm here in Old Town Torrance, and we focus on working with our clients, mostly who are business owners and multi-gen families who have an emphasis on charitable giving. So we kind of base all of this on a 4-pillar wealth management process where we will be working with our clients regarding multi-generational values and dynamics. And from that, we're able to help with our clients with their wealth transfer planning, making sure that their investments have the positive impact that is aligned with their values, which also, and then at the same time, making sure that their tax planning needs are being met. And the way that we do that is utilizing some of our partners. We think it's important for clients to have a team of professionals that they can collaborate with. And this would be everybody from us, their wealth advisors, to their CPAs, or maybe an estate planning attorney. And then when it comes to charitable gifting, being connected to a local nonprofit director of planned giving, or an executive director, or somebody that is connected to the charity or charities of choice. So with that in mind, I am so excited to introduce my good friends, Stephanie Besner and Sandy Vandenberg, to join us today. Stephanie is the co-founder and partner at Doan-Bezner, and she's an estate planning attorney up in Palos Verdes, and she specializes in estate planning, trust administration, business, real estate, taxation, and tax-exempt organizations. She is a member of the South Bay Estate Planning Council, co-chair and active member of the YPPA at Torrance Memorial, and the Professional Advisory Council at Torrance Memorial, and she is also a member of the Pastoral Council at St. John Fisher Church. So welcome, and thank you for joining us, Stephanie.
Thank you, Angela.
And I don't know if you want to add anything else to that. Okay. And then next we have Sandy Vandenberg. She is with Torrance Memorial Foundation, and she is the director of planned giving. So she has been with the foundation since June of 2013, and she works with donors to support Torrance Memorial and leave a legacy by including a future gift through their estate plan. She has been with Torrance Memorial for 11 years, where she manages silent auctions and grant writing. She's also earned her Master's of Social Work in 1995 and a CSPG, which stands for Certified Specialist in Planned Giving, in 2012. She's also a member of the South Bay Estate Planning Council and the SoCal Council of Charitable Gift Planners. She's also active with the El Segundo Chamber of Commerce and an executive committee member. And a fun fact about Sandy is that she previously taught English in Taiwan and did some social work in Albania. So thank you for joining us, Sandy.
Thank you, Angela.
And for those of us joining us live, we do have a Q&A button at the bottom of your screen, so you can utilize that to ask any questions that you might have, and we will address them at the end of the webinar. So let's just dive in, everyone. So Stephanie and Sandy, what has your experience been? Oh, sorry, I guess we should go over the agenda. Okay. So the agenda that we have today, the first thing that we will be covering is, clarifying your intended impact. So these are kind of the key considerations that you should think about prior to gifting Number 2 is charitable gifting strategies. And basically, this will cover what are the actual strategies that you can employ to accomplish your goals. And then the third will be kind of like vetting nonprofits and, what are the things that you should be looking for to make sure that you are donating, especially if it's a considerable amount, to the right charities that is aligned with whatever your family values are. And then we'll leave some time at the end for Q&A. Okay, so that's kind of where we're headed today. And then, so Stephanie and Sandy, what I wanted to ask you was, what has your experience been in working as part of a collaborative team as you've played a part in the philanthropic efforts of those that each of you serve?
Well, I have been able to, in my practice, work with financial advisors in structuring tax efficient gifts to charity. And that has largely been through employing IRA strategies, using both those assets at the time of passing, because they're gifts that beneficiaries would be subject to income tax and would be also part of the estate. So estate tax. So donors can get a double benefit for that because they would be leaving a whole dollar to a charity, whereas if they're leaving those same dollars to their descendants, there's going to be income tax coming off of that and potentially estate tax as well. But also using those for lifetime gifts as well, because when you have clients who have large IRA accounts, it might be that they are perfect candidates for making QCDs or qualified charitable distributions from their IRAs, because that can use up at least a significant chunk of their RMD, if not all of their RMD, depending on their age and how much value they have in their accounts. That means that they can use that for their charitable giving strategies and not be creating income for themselves. I know that Sandy is a big proponent of QCDs at Torrance Memorial because they're hugely beneficial.
Well, yeah, what I was also going to say, what I was also going to say about the QCDs is that, to your point, I mean, as a financial advisor, we're also huge fans of the QCDs as well, the qualified charitable distributions, not only because it helps the original, say for instance, I'm the owner of the IRA and I am at RMD age and I'm utilizing the QCDs, but since the Secure Act, since my beneficiaries now only have 10 years to distribute, it's even more valuable of a tool to try to offset my IRA. A lot of times people, what we've noticed, have an extraordinary larger amount in their retirement account versus their non-retirement account. And so it's just such a good way for them to utilize that to meet their gifting goals. So sorry, Sandy, you were going to say something.
No, that's okay. I was going to agree wholeheartedly with Stephanie on that, because with that QCD, it allows you to be philanthropic now and to support the charity at Torrance Memorial. We have a heritage society, which includes those who have included us in their estate plan. And because an IRA, we consider an IRA part of someone's estate plan. So anybody who gives with the QCD uses that for their donation. We do include them in our Heritage Society. And I also like to remind people that when you do it, give directly to the charity from your IRA with a QCD, it doesn't get added to your income. It doesn't get added to that adjusted gross income, an amount that is used for calculations and a number of other things with your tax return. So it really is a great way to be able to do that. I also wanted to mention working and related to the question about collaborating with other professionals, is that often with donors that are are giving to Torrance Memorial, we do work with their professional advisors in various ways to plan gifts and just to make sure that things are set up the way they're supposed to be. And we also here have a professional advisory council, which was noted in Stephanie's introductory slide. she's been a member of that for longer than I've been here. So it's been over 11 years, probably 12 or 13. I don't know when you exactly joined, but
14, I think.
that group, 14 years.
Mhm.
Yeah. So it's a group of estate planning professionals. So financial advisors, attorneys, CPAs, professional fiduciaries, people who are involved with that estate planning process. And Angela is a new member of that as well. So thank you to both of you for being a part of that. I provide that list to folks. I often get questions, I need an attorney, I need a financial planner, and we're familiar with all of the members of our PAC, as we call it, and they have also been very helpful in providing education to the community with the free financial health seminars we hold here on the campus every other month on a Saturday morning. So it's a very important part of my work, especially in working with planned giving.
Thank you for that. So now what I wanted to talk briefly about clarifying your intended impact. I think a lot of people, when they think about charitable giving, sometimes people don't really have a strategy. Maybe they just get hit from all sides from different organizations, whether it's the American Heart Association, the Cancer, Association, American Lung Association. There's so many different ones. So you have all of these large national ones. And then you have like the smaller local charities that we have here in the South Bay. Organizations like Sandpipers or NCL or the Richstone family. There's so many different ones that we have that's very specific just to the South Bay. And so one of the things that we always like to do when we have these conversations with our clients is, even if it's whether it's a QCD strategy or a DAF strategy, and we'll get into all of these acronyms a little bit later too, but whatever that strategy might be, we always want to try to guide our clients to figure out what might be the most impactful. They want to help a larger organization or a smaller one where their dollars will mean that much more. Do they want to be involved in something where they also want to volunteer their hours? So we do go through this process with our clients of just kind of getting to understand them better. We had this one client who she wanted to do like 30 different QCD donations of just, 1,000 here and 1,000, and we're like, you know what? I think we need to have a better strategy. So we were able to get her down to 10 and to do it monthly so that, every nonprofit is just like a business in the sense that you kind of want to know what your expected revenue will be, and your revenue stream is coming from your donors. And so we said, okay, let's do it on a monthly basis and we'll just set it up. And so she was much happier with that. Once she didn't feel so frazzled. I think she was feeling frazzled with all these different things. So, so that being said, both of you have been involved in the philanthropic area for years. Have you noticed any sort of an importance in clarifying these sorts of impacts that clients, in our opinion, should do? Do you guys feel the same way? I'm curious if either of you personally have accomplished some of your own intended impact through the work that you do professionally.
I can start on this one. I think one of the things that, personally, I have certain things I support, and some of that includes the arts. I have theater subscriptions to a number of places in Long Beach, and I like to give them additional support because it can be very difficult for them to make the ends meet, so to speak, with their financial situations. And I love the theater,
Right.
so it allows me to enjoy that and to help continue to support that. Along with other things, of course, working here at Torrance Memorial, I also do provide support here. And I think one of the things you mentioned, volunteer hours, Angela, we do have a great volunteer program. If anybody is looking for that. But also in a hospital, you have a lot of different departments and different service line areas. So people who are interested in supporting oncology or cardiology or the something they're passionate about within that, they're able to designate their gift. You know, we always like the no designation, the ones that are general support, because that helps in wherever we need it. But if there is something a donor is passionate about, they have the opportunity to designate that particular fund, whether it's with their current gifts or their future planned gifts.
And I would say similarly that my experience has probably been on a more personal level in this regard, because I tend to focus more on local organizations when I'm supporting charities, because if I'm giving $5,000 to the American Heart Association, they don't know me from Adam. But if I'm giving $5,000 to the Midnight Mission downtown, they do know who I am. And I think part of the joy that I get from charitable giving is not only supporting causes that are important to me, like Torrance Memorial and other area groups, is feeling like those groups are responsive as well and open to hearing about things that I think are important. Like, you know, participating on the YPPA, we pick a project. And one of the things that our committee decided was that our project was going to be the ER expansion. So it's nice to participate in those kinds of things and have some kind of focus on the money. Because like Sandy said, and I've seen this a lot in my practice as well, when people narrowly tailor their gifts for a specific purpose, you are actually imposing a restriction on that charitable organization, and the charity has a responsibility to track that. And they have to create these funds, and they have to manage them differently. They have to report on them differently. And what ends up happening is you can actually have charities that decline funds because of the administrative expense associated with segregating those funds for that specific purpose. Now, certainly like a UCLA is going to have a scholarship fund. And so making a gift to UCLA for a scholarship is not going to be a problem. But if you're making a gift of $1,000 to Torrance Memorial to only be used on Puffs tissue, they might say, we really appreciate your generosity, but the amount of work and admin that this is going to create for us really doesn't justify the gift. We would love to have your support, and we assure you that we are buying Kleenex at the most affordable price that we can, but we just can't create a Puffs tissue fund. And I'm not saying that to make light of the things that people come up with, because people will have had an experience in school or, you know, something as a child, and so they want it to go to the Boys and Girls Club to be used for Monopoly board games only. And I encourage people to think bigger, like think about the organization's goal as a whole, and try to support that to the extent that you can, and make sure that you're talking to the charities if you're doing planned gifts, so that any restrictions are something that the charity is willing to accept, because you wouldn't want your gift to be defeated after you're gone.
That's very true. And I would echo both of you ladies. I am definitely much more of a local charity gal versus a national charity, similar to the reason that Stephanie mentioned about they won't know me from Adam. And I like being involved with charities in my backyard that I care about. You know, my daughter and I are actively involved with NCL now, National Charity League, and we're able to, you know, donate to this local food bank, for example. And so we volunteer our hours there, and we're giving financially. So it's kind of a, you know, we're able to do both. And I love being able to get involved with something that's literally in my backyard, helping people in my backyard. So, okay, fantastic. So now I know we've already kind of touched a little bit upon, you know, QCDs and DAFs, and there are a multitude of other acronyms that I know that we might be familiar with, like CRTs and CRATs and CRETs and all sorts of other things that are out there. But maybe we can kind of talk briefly about some of these strategies that are out there, like the qualified charitable distributions or QCDs or the DAFs, the donor advised funds. There's also foundations. There are charitable remainder trusts like CRATs and CRUTs. I know as an estate planning attorney, you're very well versed in setting up some of these trust entities. Maybe you can touch a little bit about the difference between a CRAT and a CRUT. What does it all mean? And why would one choose one versus the other, for example?
Absolutely. So, one of the unique aspects of my practice is I actually practice with my father. So I've been practicing for almost 20 years, whereas he's been practicing for 50 years. And because of that, we have a lot of long-term clients. And so we've seen an evolution of planning strategies and how they've changed over the years. Your slide referred to donor advised funds and private foundations. Well, 25 years ago, donor advised funds weren't even a thing. That's a relatively recent innovation. So people were using private foundations to permanently dedicate a pile of money for charitable purposes, right? And so a family might have an income recognition event in a year and need to make a charitable deduction that year, but they don't want to say, give all of the money to Torrance Memorial right that year, right? They want to be able to structure gifts over time. Maybe they're wanting to participate in some capital campaigns. Maybe they're wanting to diversify among multiple charities. And so the family would set up either a trust or a corporation and set aside the money and get that charitable deduction. Then they had the ongoing administration of it because it has annual tax filings and you have to make minimum distributions and there's prudent investor rules and that sort of thing. So then investment management firms came up with donor advised funds. And donor advised funds are a charitable entity that has been set up by a financial management institution like LPL uses Renaissance. And they have created a charity to receive funds from their customers that they want to irrevocably dedicate to charitable purposes. And they'll create, say, the Sheldon Fund. And Angela would be custodian of the Sheldon Fund. And she would have the right to direct Renaissance how to distribute those funds. The great thing about that is it eliminated the need for administering the foundation because you don't have to do tax returns. The charity, the Renaissance, is doing that on behalf of all of the funds that they're managing. You didn't have to really have staff. There wasn't any tax on the investment income. And you could get a higher deduction because it was a public charity. Foundations, you're capped at 30% of AGI, whereas donor advised funds, because they're a regular charity, you get up to 60% of AGI. There has been some litigation in this country and in California specifically over people losing control over their donor advised funds because, and it wasn't Renaissance, like one in particular was Schwab. And I'm a Schwab customer too, so I can't say, I love all these firms. So I'm not saying it's this particular firm, but for some reason there was, in this particular scenario, the person wanted to donate to a relatively small charity. And because it wasn't a super big charity, Schwab wasn't comfortable with doing it. And it was also religiously affiliated and they wouldn't proceed with the gift. And there's about a dozen of those cases that have been published in California. So I've said to clients, if you're wanting to set aside a chunk of money and support Torrance Memorial or the Red Cross Society or some of these bigger, even like bigger regional charities that don't have any kind of potential political affiliation or anything that's going to set somebody off, you're probably fine with a donor advised fund because you're going to be able to save a lot of money on administration expenses. But if you want to be darn sure that your money is going to go to your church because that's where you're a member and you want the money to go come what may, you might be better off creating a private foundation. You also talked about charitable remainder trusts and charitable lead trusts. So those are trusts where people contribute assets, Very often you're using assets with appreciation because what you're trying to do is avoid recognizing the gain on that asset in your own on your own return. And setting that aside, getting a tax deduction, and in the case of a charitable remainder trust, say, for example, taking away a troublesome rental property and still keeping your income stream because the FRET, which it's known as, can liquidate the property and invest those assets into other securities. I would say that in life, you more often see people use charitable remainder trusts because usually what they're trying to do is pull assets out of their estate, get a charitable deduction, but still maintain their income for the rest of their life. You would maybe see somebody use a charitable lead trust strategy if they had a liquidation event where they need to get a deduction now, but they really want to put off the income for a number of years. Because the charitable lead trust says you're going to give a gift to a charity for X number of years, and then you're going to get the remainder on the other side. Whereas the charitable remainder trust says, I'm going to give this to the charity, but I'm going to get this income stream either for a term of years or for the remainder of my life. And so you'll similarly see people use these in their estate plans at death because they can help reduce the amount of estate tax that is due and can also be a creative way for benefiting family members while still benefiting charity. I had one client who he didn't have children, but he wanted to benefit his nieces on some level. So what he did was set up a CRUT for each of them where they get 4% per year for their lifetime, but whatever's left goes to the charity that he designated. And actually, right now, I'm working on a different estate plan where the man is very charitably inclined, and he's using charitable lead trust as part of his laddering strategy for benefiting his family. So he's setting some money aside for them where they benefit when he passes away, but then he's going to do this charitable lead trust. So charity benefits for a number of years, and then his grandchildren, when they're older, will get some remainder there.
Yeah, that's such a great explanation, Stephanie. And I want to also just mention that a community foundation is also a good source for a donor advised fund. I worked at the Long Beach Community Foundation before I came to Torrance Memorial. And one of the, that is an effective strategy for those who need a deduction in this year, but they aren't sure where they want to distribute those funds. So I can remember there was a donor we worked with, I think it was December 30, and he was like, oh no, I didn't do what I needed to do with my charitable giving this year, and I really need that deduction. And so we accepted a check for him just, right before the end of the year. So he was able to claim that deduction, and then over the next period of years, we're able to distribute that make grants to for based on the recommendations that donor made. And we're able to help him out with that. And so Community Foundation is a good source for that. I also just want to share a story about the impact of a charitable remainder trust. We had, when I first started at Torrance Memorial, we had a donor, she was 90 years old, and she had a rental property where the tenants were not paying their rent on time. They were not taking good care of the property, and she had it. So she decided, I'm going to evict them, and I'm going to set up a charitable remainder trust so that I'll generate the income, I'll get the tax deduction, because there was significant appreciation for capital gains tax because of the length of time she had owned the property. So we got that set up, and there's a calculation we do. It's a minimum 5% income payment, but it can be increased based on the calculations to ensure there's 10% left in that investment in the investment funds after the property was sold that goes to charity. So she was able to get a 9% distribution from that. She happened to live to be 102 years old, and she just passed away last year or earlier this year. And the Torrance Memorial is the charitable beneficiary of that remainder trust. And it was funded with about $750,000. And because of the great investment of the funds during her lifetime, there still is about $400,000 left in that charitable remainder trust, which will come to Torrance Memorial. So it's really such a great tool to make an impact to the charity and also generate the income at whatever level. Typically, the income distributions are around 5 or 6%. Maybe you have a different experience with that, Stephanie and Angela, but that is what I have seen here at Torrance Memorial. So it truly is a very effective way. We've had people fund it with appreciated stock, and you know, they are able to generate more of an income using appreciated stock and avoid the capital gains tax and the benefit that makes to their estate and the overall plan for their tax planning with those things.
And one of our participants has made a great point that you cannot make a QCD to a donor advised fund, and you similarly cannot make a QCD to a private foundation, and you cannot make gifts from donor advised funds to private foundations. So it's always important to think about, you know, like Sandy talked about the guy who was able to make a gift and draw that out over a couple of years. You know, it was great that the community foundation was willing to work with him on that, because it's not something you could do through a DAF.
Yeah, but you can actually have a DAF. You can have a DAF and a foundation, a family foundation, but you just can't. You can have them as separate entities. You just can't be using one to fund the other.
Exactly.
For obvious conflict of reasons.
Yes.
Yeah. One of the other challenges with a donor advised fund I've heard from others too is that you can't use the funds from that to you know, have a table at a gala. You can't use it for anything that will give you benefits in return. So that, you know, people who set them up, like Stephanie says, need to pay attention to what the rules are and what their intent is in setting it up.
Yes, and that's why it's so important to talk to your trusted advisors when you are interested in gifting strategies. So speaking of that, you know, some of the questions that people have from time to time is, when is the best time to give? Is it better to do this sort of gifting while I'm still alive, after I pass away? I know some people just feel like I need to just keep as much money as I can for myself right now, and then other people are a little different, and I know everyone is going to be a little different on this, but I don't know if any of you had any thoughts on that, on the best time to be doing charitable giving.
Well, I would just say it really depends on what your cash flow is like. You know, some people have more of their assets tied up in, you know, they're more in property or illiquid kinds of things. So it's difficult then to give a cash gift. But so for that purpose, I think it really does depend on what funds you have available for gifting currently. Certainly with planned giving, that is all dependent on your, you know, what your plan is to who you want to give to. And I just talked to a woman yesterday who she and her husband have retired to Hawaii, and they used to live in Redondo Beach, and she is working on her estate plan. It's a second marriage, and so she's doing her own estate plan, and she is interested in giving to Torrance Memorial. She received great care here, and so, you know, she will include Torrance Memorial with a bequest in her estate plan. So she's able to support, as she said, she wants to give to those who have helped her during her life. And so she's including Torrance Memorial with a gift, and this will come after she's gone, because that's when her you know, assets will be available and more liquid.
And I would say that this is probably a question that you should be consulting with your financial planner on to make sure that your outlays are in line with your long-term plan, because your lawyer can't help you there.
True. So we have about 10 minutes left before we get into the Q&A, and one of the big questions that we have for Sandy is, how does what are the logistics of actual planned giving? How does that actually work logistically? Like if somebody was interested in making a gift to a nonprofit at their death, do they need to fill out paperwork with the organization? And do they need to do something to their current trust? They need to restate it or make an amendment. How exactly does that work if they want to include the charity of their choice or their giving?
Well, that fits really well with the story I just told about the woman in Hawaii, because she had left us a message over the holiday weekend and saying, I'm working on my estate plan and I need to know what to include in it. And so I have people reach out to me quite often about that. And so I have prepared some sample bequest language they can share with their attorney, and most attorneys, they know what to put in there. But our tax ID number is important, the legal name of our organization, our address, those kinds of things should be included in the estate, in the trust or the will, so that when it comes time to settle that, whenever the death occurs, then they know where to send the funds. And so those are some of the things I provide. People will reach out to me with questions about what kind of things can I do. That we also work with charitable gift annuities, which also is an income producing planned gift. Of course, the bequest is the most common. Beneficiaries on IRAs and 401k accounts. That's also a great tool to use for charitable giving, because the charity doesn't have to pay the taxes on that income like the personal heir, a child, or another individual would need to withdraw it over within that 10-year period and pay taxes on it. So if you're charitably minded, you can consider using those funds for the charity and gift other assets to your heirs for where they don't have the same kind of tax consequence. That I think answers the question of how it impacts me here at Torrance Memorial.
Thank you for that. So now, I think earlier, Stephanie, you had also mentioned something about, oh my gosh, what was it? I forget exactly what it was, but what I wanted to talk about was vetting nonprofits and making sure that, we were talking about unrestricted funds versus restricted funds. So I just kind of wanted to talk briefly about that, and just why it's so important to vet nonprofits in general. There's a church that I'm familiar with where apparently there's been some mismanagement of funds, and some of the restricted funds ended up getting used for the purposes that it was not intended for. The restricted funds were not supposed to go towards rebuilding and purchasing properties, but that's what happened recently, and now they're embroiled in a big lawsuit. So what are some ways that people can protect themselves to make sure that the funds that they are giving to a charity is actually going for the intended purposes?
Absolutely.
Or that maybe they won't, mismanage the funds that they're donating to that organization?
So on some level, you are trusting that, you are looking for reputable organizations because you are trusting that they are going to do the right thing with the money, right? Sandy was talking about making sure you've correctly identified your charity. When my clients are giving to charity, I universally look them up on GuideStar, and GuideStar is a great tool because GuideStar gives you their legal name, gives you their legal domicile. They give you information.
And is that just guidestar.org?
It is guidestar.org. Okay. Yep. So it is it is a charity itself that acts as basically a directory for charities. And now for a service, they do rate charities. So if you see like a gold or platinum or bronze or what have you, it's usually because that charity is participating in their program. So don't always take the medal versus non-medals as whether that charity is reputable. But it will show you like how much in assets does the charity have. You can pull up their 990 and see who runs the organization, where is the money going. You mentioned a church. Churches can be a bit of an issue because churches don't actually have tax filing requirements. And most churches are not on GuideStar unless they have some kind of related project that they've affirmatively registered. So that can be a little bit of a challenge. But for example, like I had a client in San Diego, no spouse, no children, very charitably inclined guy. And he gave me, a dozen charities that he wanted to leave things for. And of course, he doesn't have a computer. So I went to GuideStar and went through each of the charities and printed off their little sheets. And it ended up changing a couple of his choices because I had to say these charities weren't very well run because they had super high admin expenses compared to their program expenses. That doesn't mean necessarily that you rule somebody out. Sometimes the unique nature of a charity, they might get more like in-kind donations that are funding their efforts, if you will. Like if you have a food program, you might not have a lot of money being sent on services because it is more admin focused because they're relying on donations. But GuideStar is a great tool to start with. And then if you have questions, to contact, the director or manager at that entity and to better understand how they work.
Yep. And there's nothing quite like rolling up your own sleeves and working with that charity to really have an understanding of what it is that they actually do.
Yeah.
Yeah, I'd like to add here at Torrance Memorial, we really try to engage our donors with, regardless of what the amount of their gift is, just trying to keep them informed of what's going on. And sometimes that's a good way to start too. You make a smaller gift and just kind of get an experience with that charity and see, how they're stewarding their donors, and are they keeping me informed, or are they going to use it the way I intend it to be used? And so building that relationship with the charities of choice and what you're committed to is really important in the process. And from the charitable recipient point of view here at Torrance Memorial, that is something we really try to do is stay connected with our donors.
Well, thank you, ladies. So we have a question that I want to cover. The question was, what would be a baseline of the value of an asset to set up a CRT for it to make sense with the cost of setting it up and administering it?
I can speak for Torrance Memorial. We typically look at a minimum of 100,000. That the value of it is going to be 100,000 or more. The ones we have in place are usually, I think the lowest one was maybe 300,000 was some appreciated stock that was set up a few years back. So, but yeah, there is a cost involved. You need a legal document, working with an attorney, getting an appraisal, and all of those kinds of things are part of it. So but that's kind of been our rule of thumb.
Right.
And
And
a lot of that's going to depend on who's administering it, right? And so I would definitely say you would not want to do it for less than 100,000 for sure.
Right. Or I mean, I feel like it needs to be personally even more than that, just because of the cost of setting it up and the yearly taxes and everything that goes along with it, having to file the taxes on it. I mean, every time you go to a CPA and file the tax return on yet another entity, that's just X amount of dollars on that as well. So we usually tend to shy away from that unless the client has at least $500,000 or more that they want to put into a CRT of sorts. But once again, I think it just depends on every situation. We had this one client who was having a situation with some properties that he had sold, and he didn't want to do a 1031 exchange. And so what we were looking at doing a NIMCRUT, which is a type of a charitable remainder trust. And so we were looking at doing that, but eventually, after weighing the pros and cons of that versus just paying some of the, because once you put it into a charitable remainder trust, you also can't just tap into it whenever you want. And I think that's always a little concerning for clients too sometimes, that, oh, wow, this chunk of money, I'm not going to be able to access it. I just get the income from it. So, I mean, there's no like rule of thumb necessarily, but I would say like $500,000 is ish for us. Okay,
the other thing I'd
another.
like to mention, could I quickly just state too that many of the charitable remainder trust documents, when they're put together, there's a clause in there that allows for additional assets to be added. So once you get the document set up, and you decide in the future, oh, I have some more appreciated stock I'd like to put in here. You can do that without having to set up a new document. So there's that initial establishment fee for that legal document, but then you can set it up with a clause to add more to it in the future.
Now, another question is, do either of you think that there is a maximum number of different charities that is considered ideal?
So I guess it kind of depends on what your strategy is, right? Like, and how much you're giving. If you're giving $1 million a year, you could spread that out around quite a bit and still really have an impact. I mean, personally, like my big gifts are really to probably 4 or 5 charities. But I have clients who it's funny, I have an estate plan that I did within the last year, and they're husband and wife, and they're leaving everything that they have to charity, and they each picked what they're doing with their half of the assets. So he is giving his half of their estate, which is probably going to be about $3 or $4 million, to 5 charities, and she is giving her half of the estate to 37 different charities.
Oh my gosh.
But that it was very important to her, and she's the kind of person who she supports a lot of different groups.
Wow. 37.
Yeah,
Any thoughts on that, Sandy?
I can't add anything. I think Stephanie, you state that very well, but I just want to add at this point too that, sometimes we have a major donor here at Torrance Memorial, Richard and Melanie Lundquist, and they have given over $100 million to the hospital. And so I've had people say, well, I can't give that kind of money. And so, and I always want to remind people that even with a big organization like Torrance Memorial, every dollar makes a difference. And so if you can give $10 or $25, we welcome that gift, and it all makes a difference. So, but I think Stephanie stated it very well about the maximum number or what the ideal number is. It depends.
Yeah, I think so. And then what is the average cost for the setup of a charitable lead or remainder trust? For example, attorney fees, and any other fees that would come with that.
I'm going to let Sandy answer this because she works with lots of different attorneys, whereas I am one attorney. So she's going to be better able to give you the range.
Yeah, I was hoping you would answer that, Stephanie, because you create them. But there is the legal fee. I don't remember exact numbers, but it's probably going to range anywhere from $1,500 to $2,500. That's kind of round figures for the legal document. There's usually an appraisal if it's a rental property or a piece of property. An appraisal is required, and that can, I don't know, probably run anywhere from $800 to $1,000. Torrance Memorial is willing to help reimburse some of those fees based on the percentage we receive as the remainder. So if we're going to get 100% of the remainder of that charitable remainder trust, we will help reimburse the fees to set it up as well.
I concur.
Sandy.
I'm in the range
now
there,
I know
legal fees.
Now, I know we touched briefly on this already, but what is the difference of a DAF or donor advised fund and a family foundation? Which is better and why? Um, I think we briefly touched on it when we had the chart up, but basically, in a nutshell, the DAF is going to be easier to set up versus a foundation, I would say, in terms of, with the DAF, you don't have to do any of like the tax filings or the administration or anything like that. Whereas with a family foundation, you are creating a board of directors and you actually have an entity that you have to get a tax ID for and do tax filings, et cetera, et cetera. I don't know if one is necessarily better than the other. I think ultimately it depends on what you're looking for. I think if you're looking for something, and it's not to say that you can't have both. I think we said that earlier too. You can have a DAF and then also set up a foundation and and the nice thing about the DAF is that you're not required to give a certain percentage out of it every year. Whereas with a foundation, you are required to do a distribution of a whatever percentage every year. So you have that difference. And then in terms of the deduction that you get for cash right off the bat, the DAF will give you a bigger deduction versus the family foundation, 60 to 30. So you do have
Could
those
I
differences,
add,
but then with the, yeah, go ahead.
could I add too, a dollar amount is really kind of an important factor too, because when I was at the Long Beach Community Foundation, and that was 12 years ago, but you could set up a donor advised fund with a minimum of $25,000. So if you're gonna set up a private foundation, you probably should have a couple $1 million to really make it worthwhile. And, because of all the administrative costs and all that other kind of thing. So with the donor advised fund, you can set it up with a smaller amount, you continue to add to it, or you can pay it all out. And you don't have all of that administrative, cost. You also have the opportunity to be anonymous because you can tell the community foundation or whoever it is, I don't want my name attached to this. You can send the money, but don't let them have my address or anything. So it keeps from getting all that mail and getting on everybody else's list.
And I mean, I've actually done private foundations that have been more at the $500,000 level. So I don't think they necessarily have to be huge, but like Sandy said, DAFs are a great planning tool for the smaller dollar amounts because 500,000 is still a big number when you're talking about permanently dedicating money to charitable purposes for most of us. And so it's the DAFs are a great tool for smaller amounts and still for larger amounts too, depending on what your long-time goals are, how much management you want to have, et cetera.
Yes, and just for information purposes, you can do publicly held stock, or you can also do private shares of a privately held corporation, in case anyone was wondering about that. And you can also do real estate. So these are all the different types of appreciated assets that you can put into either of the DAF or the family foundation. Okay, so I think that's it for questions. Thank you so much, everyone, for joining us today. It has been recorded, so the replay will be available for those of us, or for those of you who are not live. And we will also have it available on our website. And if you want to delve further into any of these specific topics with any of us, feel free to reach out. Thank you all, and we hope you have a nice day.
Thank you.